Hello Sector Watchers, welcome to the show. This is the 59th episode of Sector Spotlight on Tuesday the 8th of December, recorded on the 7th. My name is Julius de Kempenaer and I'm your host for today's show. In case you did not know it yet, I love to hear your thoughts and ideas, so my contact details are on the slide and you are invited to use them. Your comments and questions keep me on track and often give me ideas for future shows or blog articles. You're free to choose the channel that suits you best. Email is fine, but also the comment sections below videos and articles are great places to communicate. As usual, we'll have a look at last week's performances and rotations, but as this is the first Tuesday in December, the majority of this episode of Sector Spotlight will be spent on an update of the completed monthly bars for November and seeing what that means for long-term trends in asset classes and sectors. What happened last week with performances and rotations? We have the RRG for asset classes on the left-hand side of the screen and the RRG for sectors on the right-hand side of the screen. I'm going to sort the table on percentages so we can read easily the performances for the various asset classes, and we can see that our benchmark, the Vanguard Balanced Index Fund, gained 90 basis points. Everything above that white line has been outperforming our benchmark, so that's real estate with 1.8%, stocks 1.8%, and even corporate, well, that's in line, corporate bonds also 90 basis points higher. Below the white line, we find the underperformers for last week. For the last 5 trading days, so that is Monday to Friday, it's ending December 4th, and we see corporate bonds there minus 50 basis points, treasuries minus 80, commodities down again 1%, and a real weak week for the US dollar with a loss of 1.2%. If we look at the rotations for last week, so we go back 1, 2, 3, 4, 5. This is where we started the week, and we saw that fixed income complex, including the dollar, were sort of picking up in momentum. And if you then look at what happened during the week in 1, 2, 3, 4, 5 days, you see that at the end of the week, that stocks and real estate started to turn, and that whole fixed income complex started to curl back down into the lagging quadrant. So stocks picked up their leadership role again, and the fixed income stuff, especially government bonds, backed down, basically following the expectations that stocks are still outperforming bonds. Interesting rotations for GSG, commodities, doing pretty well inside the leading quadrant, especially if you compare it to DGP, which is the Bloomberg commodity equivalent. GSG, more oil, more energy stock, energy commodities. Bloomberg commodity, more equal weighted, and you can see the outperformance of the energy commodities in this graph. If we switch over to the RRG for sectors, then and let's rank that also on percentage gain. We see another very strong week for the energy sector, up 4.4%, compared with SPY, the benchmark for stocks, up 1.7%. Another pretty good week for healthcare, 2.8%, technology 2.8%, communication services, glad to see, because that was our pick based on seasonality, up 2.1%. We were expecting for the rest of the month communication services to outperform technology. So far that's not happening yet. They're moving in line, tech leading slightly. Financials picking up, doing well, following their path that we see on the weekly RRG, picking up there 1.8%. And then we see real estate below 30 basis points below SPY, 1.4. Staples 1.1, industrials, materials, consumer discretionary and utilities were the only sectors that also had a negative performance for the week, both minus 10 basis points and minus 2.1%. This week we are looking at long-term charts, so I'm going to leave the overview for asset classes and sectors at this, and we're going to have a look at the monthly charts for both asset classes and sectors. Let's start with the monthly charts for asset classes. I have a list and we're just going to work our way through that list. It starts with ITOT, that's the core S&P total US stock market. So that includes everything, large, mid, small caps, everything. And be careful, because of the date and the Tuesdays, we're already almost a week underway. So the last bar on the charts that you will see is the first week of December. So we're going to concentrate on the completed bars for November. So in the case of ITOT, that's that big last bar up that broke above the previous high. So that is just a good sign for stocks. That is basically confirming its uptrend. If we look at SPY, that is the same, and I like to, because it's a total return chart, I like SPY to be the unadjusted version, so with the underscore above it, because I believe it gives a better idea about where support and resistance levels are. But in the big picture, we also see that for SPY, the last bar of November, the monthly bar, managed to break above its high for September. So September, October, November, and we're now in December. So it broke to new highs. This is an uptrend. Stocks are still in an uptrend. There's nothing we can say about it. We can come up with a lot of negative narratives for stocks and why they should go down, but they don't. They don't go down. And as long as they don't go down, they are in an uptrend, and we have to follow and just accept that is the case and enjoy it, because who doesn't like stock markets that go up? If we go to the next one, it's a little bit more zoomed in, a little bit more annotated, and you can see that we actually a couple of months ago broke above. This was an important level, that 338, 340 area. We broke it, and it looks as if we're now really clearing that level. We're above that old rising resistance line, so no problem for the stock market whatsoever as of today. We're going to quickly go to the unadjusted versions for the adjusted versions for GOVD and IEF. Those are the total return charts. What people are actually having in their mind is GOVD unadjusted. Now, I wanted to tell you, forget about the last bar, but it's very hard when it's such a nice break. So when we look at the November bar, we were, even at the close, still holding above that previous low. Now, that is not the case anymore at the start of this month. If we go back to the adjusted version, then you see why that is. We're still above, and this is with the dividends paid out for GOVD. In terms of what's in people's mind, I believe that the unadjusted versions, like sort of the futures price, is a better gauge, and it looks as if we're breaking down. Not yet happening for IEF. That is still pushing against that support level, but when you look at that chart, you can, I don't know, I see that I sense that it is trying to break lower, to push down below that previous low, which for IEF is 119.35. A monthly break below 119.35, I think, would complete a double top and push yields even higher. We go to investment grade corporate bonds, that's LQD, then we see a similar picture. We try to break higher here, area around 138, 139, not happening, and the market is now starting to come down. At last in November we closed against the high, and this month we're starting to move lower. A little bit more leeway before it breaks that double top pattern than IEF or GOVD, but the image is quite similar. We move to high yield corporate bonds. Then it's slightly different. It's still in that trading range, working its way higher. So if you have to choose between GOVD or IEF, so government treasuries, and corporate bonds or high yields, based on these monthly charts, it looks as if the high yield section has the better upside potential. Here you can see that we took out the recent high and we still have some room to move towards the upper boundary of the range, which is roughly 89 US dollars. So of these three, I would prefer the high yield corporate bonds. Just to give you an idea what the difference between adjusted and unadjusted is, very well visible for high yield. Here you see the high yield, but this is including the coupons or that are paid on the bonds, or in this case the dividends on the ETF. And that's not where people have actually traded these highs and lows are adjusted because of the fact that it's an adjusted price series. And here you see the raw price series unadjusted, and you can see that there is this very nice trading range panning out, which we just explained. We go to real estate. That's another sector or asset class that's very sensitive to dividends that are being paid out, so I prefer to look at this on an unadjusted basis as well. And here you see that we have there's basically two trading ranges. There's very clearly the lower end of the range around 71, slightly above 71 US dollars, and there are the two major highs, with this one it's a sort of a cluster, and I think that probably the area of resistance is 93-ish, around 93. And then you see this level here, which is almost 86, 85, 83, let's say rounded off at 86. And you see was respected here back in 2007, then it showed up again in 2015. We broke it in 16, and then we had a few attempts in 2017, again in 2018, then we broke it in 19, pushed higher, break lower, and now we're back against that level. So the 86 area is very important. If that goes, then we're looking at maybe 93. If that doesn't work, then we're looking at the low 70s for real estate. But in the big picture, there's not a massive trend going on. It's moving sideways, but it's a broad range, and the broad range might offer possibilities for some swing trades. But longer term perspective, as far as I can see right now, this would be a sideways movement for me. We have our two commodity indexes. Here is the Bloomberg Commodity Index. You see that it is still struggling. We came back above the support, then resistance, and now acting as support again from that 2016 low. The series of lower highs is still there, and for the last 3-4 months we're still struggling with a resistance level that seems to be coming off these lows here that we saw in 2018 and 2019. So this is 2018, late 2018, and these are 2019. So the upside for the Bloomberg, for DJP, the Bloomberg Commodity Index, in my opinion, is still very limited because of this old support, now resistance, and that falling resistance line coming down over the highs. If we switch that to the GSCI Commodity Index, GSG, we see slightly similar, but GSG, despite the fact that in the near term it is looking a little bit better than DJP, in the long term you see that GSG has not been able to come back above this 1999 low, which was respected in 2016, 2017, again in 2019 and early 2020 when it broke, and we're now pushing our way higher, but that is only a short-term improvement, and we need a lot more improvement on the monthly basis to turn this massive downtrend around. Let's quickly move to, no, we're still in that one. Quickly move to the dollar index and the US dollar. That is that's a pretty serious break, I think. So here you see the dollar index broke that uptrend, had a small consolidation, and it's now breaking lower from that consolidation. I think we're looking potentially going to 88, and if we translate that to euro dollar, just the major, then we see that massive downtrend coming down from 2009 and lower is now broken, and it looks as if we're going to go back up to 125 in US dollar, in euro dollar rate. So that is a strengthening of the euro and a weakening for the US dollar. Last one here is the two last ones actually. ITOT versus GOV, that's the ratio stocks bonds, now very clearly breaking out in favor of stocks over government bonds. So we've been discussing and contemplating over the last few months, will it happen, will it not happen? It now clearly happened, there's no doubt. You got to prefer stocks over bonds. And that immediately translates to something that I'm tracking very closely, and that's the relationship between the yield curve and the S&P 500. And this chart, we've talked about it before, shows the yield curve. That's the blue line. It's the difference between 10 years and 2-year yields on treasuries. It's moving higher. The gray line is the 12-month moving average. And what I'm still looking at is the dips, because what I found and what I explained in a previous version of Sector Spotlight, you had the turnaround, so from either inversed back up, at least moving from a flattening yield curve to a steepening yield curve. And it looks as every time when that happens, initially you have a drop in the S&P 500 in the stock market, and then you got a rise. What I'm not sure of is whether the dip that we had at the start of the year was the dip and then moving higher like the dips that we had before, or are we facing a more serious dip? That's the only sort of slight negative that I can come up with. But as I said before, the chart itself, and that is by far the most important indicator, is still pointing to higher prices for stocks and higher yields. So that is a spread, so stocks going up, bond prices going down. It's massively in favor of the stock market. We'll have to wait and see how that goes. This is the only thing that I'm keeping an eye out with a little bit of a caveat on potential risk that is there. We're going for a quick break, and we'll be back after that with monthly charts for the sectors. And welcome back. For this segment, I wanted to try out a new screen layout. You know how I had the 50-50 spread when I do my RRGs and my charts, but for the monthly charts I like a real nice big picture, as you see it on the right for SPY. So I've shifted my window for the RRG a little bit more to the left, and I cut out the benchmark chart that you usually see on the right. So I got more space for the monthly charts on the right hand side. Let's move through those sectors and the monthly charts in combination with what we see on the RRG. So just to make sure, because we're looking at monthly charts and the RRG is based on weekly data, you may see some differences. We're calling the monthly charts in terms of absolute performance, just looking at those long-term trends. So what we see on those monthlies does not necessarily have to match with what we see on the weekly relative rotation graph. However, when we see a nice trend on the monthly and it matches with the tail and the rotation of that tail on that weekly RRG, obviously that's beneficial. That's added evidence for a move in that direction. Okay, sorted out this on alphabetical order, and now we have materials, which by the way is still very high. It's moving down, but it's very high on the RS ratio scale. So let's bring up that monthly chart, and very rapidly we see that this is a very nice long-term uptrend. It broke higher a couple of months ago already, still holding up great. We see on the weekly, this is the short term compared to the monthly long term, some setback, but it's in weakening at a very high level. So there's all the possibility for the materials sector to curl back up and go back into leading, driven by that long-term uptrend on the monthly chart. If we go to communication services, XLC, then you see that that tail is now back into the leading quadrant on that weekly RRG, which is good, which is also what we expected based on the seasonality. And you see that the monthly chart, last November we broke to a new high, albeit marginally, but this week, the start of December, has already been pretty good for communication services. So this uptrend, this long-term uptrend on the monthly, is certainly backing the strong rotation of XLC on the RRG. So stay with that. If we look at energy, that is obviously a massively long tail. We've been looking at that for ages. And if we look at the monthly chart, then we can see that, in percentage terms and in relative terms, that is a pretty big move. But the long-term trend, there's a reason why XLE is so far to the left. It's completely detached from all those other sectors. And I still doubt, despite those massive gains that we've seen for the energy sector recently, this long-term chart still worries me. There is so much overhead resistance for short-term plays, tactical plays. Be my guest. Definitely worth looking at, daily and weekly XLE charts, and you can gain some. But for the long-term trend, lower highs, lower lows, detached to the left on that RRG. So be very careful with long-term overweight positions in the energy sector. It's different for financials. Financials did not have a very good stint for quite some time. And you see why. We broke out of that channel, but we're now convincingly back. Remember that this last before 1 is the last completed bar for November, and that brought us convincingly back in that rising channel. So financials seem to have shrugged off that resistance in that 26 area, and has now got all the way upside potential to levels above 30, 31, and maybe even towards the top of that channel. And that is backed up by a strong rotation on the RRG, where XLF is now actually moving into the leading quadrant and moving further into it. If we look at industrials, that is in terms of RS ratio, still the strongest sector in the universe. And the price chart, the monthly price chart shows why. Because in November, it was a very long bar, so it was a very good month for industrials. We moved beyond that previous high and we're holding up there. So the way up is free, the downside is well protected at the level of that previous high, which is around 84. And with XLI and that tail being way out to the right, there is plenty of room to wiggle for XLI, and just like materials to curl back up inside weakening and go higher. XLK is leveling off on the tail of XLA is leveling off inside the weakening quadrant, but it's getting closer to crossing over into lagging, and that's what's making it a little bit worrisome. If we look at the monthly chart, and we can see that XLK is obviously one of the very strong sectors that we've seen over the last few months, but for 4 months already we've not been able to push to new highs, and November was no different. This week has started good, but 127.44, 127.5 roughly is a very important level. I think we need to break that to bring technology back into the game, and until that happens, I'm going to watch that tail here and hope it's not going to cross over into lagging, because that would mean a further serious weakening for the technology sector. So keep an eye on a break of that 127.5. If it doesn't happen and we start to work our way lower from that resistance level, then we have more weakness ahead in the technology sector. We look at staples now moving into the lagging quadrant, and we see a strong monthly chart for staples. We've seen that for a long time. It's breaking out of that rising trend. But what's difficult to see, and that's where the use of RRGs comes in, this is showing very clearly the relative weakness of staples versus the benchmark and versus the other sectors here on the right. You cannot see that on this chart. So despite the fact that the price trend for staples is still good and strong, on a relative basis, there are sectors and the market as such that's doing much higher. If you want a stable investment and not worry about beating the S&P 500, staples definitely is a good sector to invest in. If you want to beat the S&P 500, you need to forget about staples. Real estate, pretty much the same. It's rolling over, curling around, rolling over back into the lagging quadrant, and you can see that real estate did not manage to move higher. It's now running into trouble around 38, and this is, I think, over the last few months, getting a pretty strong resistance level around 38. So the odds are higher that we will see a move lower, potentially back to the lower end of that consolidation area, back down to 34, and that is certainly ignited by that move, by that rollover into that lagging quadrant. If we quickly go to utilities, then we see that is inside that rising trend, same as staples, rolling over, inside, improving and moving further down. So from a relative point of view, utilities should be avoided. From a price point of view, it's a very stable trend. If we go to healthcare, I've got to speed it up now. Healthcare is in a stable uptrend outside of its channel, but it's making weird moves inside that improving quadrant. It doesn't really know where it's going. So it's now still underperforming the S&P 500 and the other sectors, in line with utilities and staples basically. And finally, the discretionary sector, together with technology inside that weakening quadrant, moving further to, and we need to change this to an open high-low close chart, and we see that that uptrend is still there. We moved higher, but from a relative point of view, that pace is not enough to beat the S&P 500. Keep an eye on this one. Still has the possibility to curl back up, but not right now. And that concludes the journey through the sector landscape using the monthly charts for November. And it also means the end of this episode of Sector Spotlight for today. Thank you for watching. If you liked the video, please let us know by clicking the thumbs up icon. If you have any questions or remarks, please use the comment section below, where you will also find my responses. So don't be shy, I won't bite. Again, if you prefer email, my mailbox is open, and rest assured that I do read my mail and I will answer, although it may not be the next day. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern, with replays on the StockCharts YouTube channel. For now, please stay safe, and I hope to see you again next week for a new episode of Sector Spotlight.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.